My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. If you've been in real estate investing for any length of time or you've been around it, you've heard about so many people scaling things up, going out from single family homes, getting into big multifamily properties. And it seems like so many people really think that to scale their real estate investing business, they need to start bringing down 70, 100, 120 unit apartment buildings. Well, today's special guest, Ray Heimann, who is zooming in all the way from beautiful New York, does things differently. He's in the multifamily space, but he focuses on sub 20 unit buildings, but at scale. So very interested in finding out about all of that. So Ray, welcome to the show. Great to have you.
Thanks, Dave. Appreciate you having me on. Big fan of the show and happy to contribute here.
Awesome. Very good. So how did you kind of come up with this unique twist on multifamily investing? What was kind of that epiphany moment for you?
Yeah, so I went to school in New York. I grew up in Cleveland, Ohio, and made some people would call it a mistake to move to New York City. I enjoyed it. But I went to school out here and started investing in multifamily properties with my still business partner while we were still in school.
Wow.
And so we were
Did you come? So
buying.
sorry, getting off track here. Your guys were university students investing in multifamily. Do you come from really, really wealthy families and you just got these, you know, funds, unlimited funds for doing that, or how'd you guys get involved?
No, we exhausted those funds pretty quickly. And Dave, I had two majors too, so it's not I wasn't just taking ballroom dancing, but it was really just getting fantastic off market deals that allowed us to succeed. I mean, New York City cap rates at the time were in many cases sub 4%, and we were bringing things around that were 6.5, 7%. And so it's pretty easy for us to raise capital. And that was 2012, 2013. People are pouring cash post financial crisis into some of these multifamily properties, and they were total home runs. But they were all smaller deals because we knew that we'd never have the support to go out and pull out 15-20 million dollar fundraise off, but we could fundraise $1 million or something like that and buy a 4 or 5 unit property. So we're always buying smaller walk-ups. The world changed. New York City became increasingly more difficult to operate in. We started kind of toying around with some other markets. We started investing in Pittsburgh, PA, which is one of our markets to this day. And it was just a total light bulb moment. Like the 6-7% was more like a 9-10% stabilized yield on cost. And there is just an absolute sea of small multifamily properties in that market, similar markets that are great locations, but are totally under renovated. Frequently have got some vacancy. The brokers don't touch it because brokers are all doing single family homes all day. And it was just like, whoa, I think we can go in here and buy most of these things off market, super unsophisticated sellers, get great basis. We got to put in the elbow grease and get a great team of renovators, contractors, lawyers, et cetera, and build that out. But we were able to do that, and we have just been very successful in that space. So we have continued on that exact same strategy, largely off market buying, doing the renovation structuring all of ourselves. We've done very close to 100 of these deals now, and we've expanded started in New York, launched in Pittsburgh in 2017, and now we're fully up and running in Pittsburgh, Columbus, and Indianapolis, and acquiring at a pretty good clip today. We're doing 9% plus stabilized yield on cost in markets where we're getting anywhere from 6.5 to 7% rates on interest rates. So we're nicely above. We've got a good spread versus interest rates. And so it's been a nice little niche for us. It was tough sledding, getting everything built up.
Mhm.
But now we're at this point, and it's going very well. But the sub institutional and especially sub 20 unit space, there is a lot of opportunity in there if you're willing to dig down and find it.
Well, I'm just curious, what were the two majors you were majoring in university as you were doing this side gig at the time?
Math and philosophy. So I was doing
Wonderful.
two things that were so non-applied, and
Yeah.
then at night doing something incredibly directly applied.
Well,
But hey, it was a good mix.
I'm sure the math, the crunch and numbers thing comes in handy. That's for sure. And
Yeah,
there's a draw to being philosophical about a few things with real estate. That's true as well. So
yeah, it didn't hurt, and I can hit you with one uh philosophize math, maybe conjunction here, but something about the small multifamily space, a lot of people consider 50 units or less. That's just blew my mind, and we kind of didn't even figure this out until after we've been working in it for a long time. But some 80% of the US multifamily housing stock by unit count
mhm.
is in buildings that have 50 units or less.
How much? 80, how much percent?
80% of the
80%.
units.
80%
And
of all multifamilies are 50 units or less.
yeah, and so obviously a lot of US housing is single family homes,
Yeah, yeah, yeah.
but everyone's chasing that 20% of multifamily, which is
Mhm.
in larger. Now, obviously it's better to, take down one 500 unit deal at once, you have one negotiation, one, et cetera. It's easier for you.
Efficiency of the
But
sale a bit, but yeah.
uh,
But there's
but
so
you've
much
got
competition in that field, right? Especially if you're a quote unquote small guy trying to compete against funds and whatnot. And
yeah,
yeah,
there's so much competition, and the vast majority of those properties are already owned by very, very sophisticated institutional groups and family offices.
yeah.
Whereas the smaller properties are owned by these little tiny mom and pops. So it's just
But
kind of blows my
even in
mind.
the smaller property space, you guys are kind of niched down to 20 units and below. So what does your portfolio look like right now? Like total number of units under under management or ownership, and then what does that translate into as number of actual buildings in the portfolio?
Yeah, so we bought a property management firm. So our total number of units under management
Oh,
is
okay.
is a little higher, so closer to 2,000. But that's a good example of something that just doesn't exist for small multifams, good property management.
Yeah, yeah.
Not to say that there's no one out there. It's very difficult to repeatedly find groups in different cities that are good for it. So we bought it and kind of morphed it into our own tech enabled group with um, local presence and knowledge. But our owned portfolio is pushing 700 units right now.
Wow.
That's across just over 50 deals that are not, syndicated deals.
Hmm.
So you can do the math, but we end up in that kind of low to mid teens range on average
Yeah.
for unit size, and that's great. Our original portfolio had a lot of duplexes, triplexes in it. That is a fantastic opportunity and has worked out really well for us because of house hacking. So
Yeah.
now those things are way more valuable than we ever kind of projected they would be, and so we've sold them off and made a nice flip. But the long term kind of cash flowing opportunity is really in that slightly larger space. And the tagline we always use is this: is like, it's too big for flippers. It just is. They just
Yeah.
don't have enough cash to do that. I mean, most flippers can do a handful of single family homes a year, but they can't knock down a couple 12 unit apartment buildings.
Hmm.
So it's too big for flippers, and then it's too small for developers. There are
Okay.
almost no developer groups out there that are like, hey, I'm getting really excited about even a 50 unit building. So that is that's been kind of a nice in between space.
Now, I understand you guys have gotten very good. Well, you're very good in your college days raising private capital for these deals. If you're raising $1 million to buy properties while you're still drinking beer in university, you're doing something way righter than I was at that age. That's
Dave,
for
my
sure.
mom might listen to this podcast. Don't tell her I was drinking beers.
Well, she might have suspected that anyhow. But um,
Maybe.
What's kind of been your method for success with raising private capital initially and then nowadays? So kind of compare and contrast.
Yeah, I think the number one thing is to always just be super transparent, high level of integrity, deliver on what you're going to do. It sounds trite, but the under promise, over deliver. Yes, it's harder to sell your 16% IRR deal than a 25% IRR deal. But once you sell the 16% and then you deliver 25%, you're not going to have to sell anymore. So there is a lot of it to that, especially when we were raising small chunks of capital up front. I would say that now we have evolved a little bit into, we still have high net worth individuals. We still have folks that, qualify for 506C or credit investors and stuff like that. And they contact us, they join all the time. There's no problem with that. But the main source of our capital is sort of quasi institutional capital that comes from fund of funds. Sometimes that is run through a sequence of family offices. Sometimes that is its own independent, institutionally backed fund of funds structure that is going to dig into what we are doing. We are very institutional grade and above. My background is in banking, consulting, private equity. My partner's background is institutional real estate development. So it's very easy for us to go through those processes, show them all the good stuff that we're doing, and get kind of one set of sign off and deep due diligence for a large check. And so we've kind of migrated towards that.
Hmm.
But the fundamentals remain the same. Don't put anything out there that you're not really sure you're going to be able to do, and make darn sure that when you do deliver, it's as good or ideally better than what you said.
So for these kind of guys, especially family offices and fund of funds, aren't your deals kind of small, or are they funding a whole schwack of them all at once kind of thing?
Yeah, so it's more the latter, especially with our sub 20 unit deals, and we really do look at anything sub 100. But for sub 20, which is our specialty, we have a committed capital fund, and because those deals are too small really to syndicate, having a fund structure is what has helped us be able to close quickly, all cash where we need to, make fast decisions on deals that would otherwise be bought by kind of a local mom and pop player. So we have done it in that way, and those fund of funds will actually come and invest in that, discretionary fund entity.
Mhm.
Um, and so they can go and put their $5-10 million, whatever it is, to work, um, in our fund, and that makes it easier. With the syndications, we tend to be very conservative on leverage, so we'll still have $5 to $7 million equity check for those, and it makes it somewhat more easy for those larger funds to do that. But you're 100% right. The everything about the small multifamily space, and specifically sub 20, is that there's just no structure in place really to do it today, whether that's lending, whether that's the equity structure, contractor base, property management, leasing, all that stuff. You kind of have to build it, from scratch. It's not really like, a lot of the technology from single family home aggregation we've been able to leverage, and a lot of the
Mhm.
strategies and kind of high volume acquisitions we've been able to piggyback off of. But it just doesn't have the same level of infrastructure that even single family home aggregators have.
Very, very cool. Now, do you ever run into any challenges with these family offices and these bigger players that they just want too big of a piece of the pie, or they just want to control too many things? I've heard that being a challenge for a few other people.
Yeah, it is. And we try to accommodate groups as best we can with that. And there's always ways to put together a special purpose entity or a sidecar or something like that, or something that only looks at deals that are slightly larger but outside the fund, whatever it might be.
Mhm.
Um, and so we do that to accommodate, similar to how we've been able to do everything else at scale. Systems, processes, and tech allow us to do that. So we have a third party tech enabled fund admin that makes that at least bearable,
Mhm.
but it's complicated.
Yeah.
And I think, everything below truly institutional capital has got all these rules and requirements and goals, and that are so specific to that investor entity, that you kind of just got to be along for the ride and figure it out. But that said, we're always going to prioritize folks that want to participate like an institutional investor, and
Mhm.
kind of take their 2 and 20 passively, 7.5 pref, and just, sign off on it and, come back for the quarterly reports.
Yeah, it's one report, and you're not dealing with a gazillion individual retail type investors.
Yeah. Our single most difficult property to manage is a 4-unit property in East Village, in Manhattan, that has one one investor who's fantastic, has invested with us for many years, but that's one where he's really plugged into the day to day, and those are
Is he
always
living in
the
the
least
place?
fun.
Is he living
No,
in the
he
place?
actually he actually lives down the road, and so
Okay.
the trash can that was overfull or whatever. So you get all that, but then since then we've got he's invested pretty heavily with us, so we
Yeah.
uh, gotta if he's listening, you're the best. But
I
it always
understand. It
makes it easier
complicates things.
when you've got direct control over things and at scale.
Awesome, Ray. So moving ahead, what are your plans for the next 12 to 24 months?
Yeah, so we see a pretty massive opportunity with interest rates being higher for longer, and so we don't have any special interest rate insight outside of what Wall Street consensus is. But as long as interest rates stay relatively high, we are in an advantaged position just because our yields are high enough that we're still in the multifamily risk range. We can still be in urban infill location. You kind of think of our product as like the 12-unit old apartment building that's completely refurbished and modernized, but it's 3 blocks away from the massive new development from some point over the last 5 years. And so we want to really just continue delivering on that same path. We would like to add a couple of markets to what we're doing today. We're in the Midwest right now: Pittsburgh, Columbus, Indianapolis. We have a couple other that are in our crosshairs there. We like markets that are heavily indexed in healthcare and education, very sticky, recession resilient, maybe not the sexiest markets,
Yeah.
but if there's a downturn, we'll feel good. And so continue taking advantage of that arbitrage between where our stabilized and levered yield on cost is and where interest rates are falling. Continue to go after good, solid, long-term markets, and continue to make choices that are, to what I was saying earlier, is that I can go and invest there confidently. And I know that when I deliver returns to investors, it's going to be as good or better than what I had discussed previously. And I think we'll continue to get attention just because of that yield arbitrage in the market. And the Midwest is where I'm from originally. It's not the reason we invest there. The reason is much more calculated, but it's been fantastic to us. I think the rent growth numbers and occupancy numbers speak for themselves out there. But there are some places in the Midwest that are not interesting over the next 2 months or even 10, 15 years. And then there are places that are extremely interesting over the next 5 to 10 years. We think we have located ourselves and will continue to locate ourselves in the latter. But that's the plan. Keep expanding, keep buying, build density in our current markets, and make good investment decisions.
Well, that's awesome. All right, Ray. Well, as we wrap up, if people want to find out more and connect with you, where should they go?
Yeah. So number one place is probably USATerra. .com.
Mhm.
That's Terra, Terra. We have a bi-weekly newsletter that is very easy to sign up for once you're on the website there. It's got a lot of good market and small multifamily news, so would highly recommend that. Some good ones recently are the Ozempic alternative. Manjaro is made by Eli Lilly, which is an Indianapolis-based company that
Ah,
they're
I,
doing it.
I was trying to figure out how's the connection there, but yeah, healthcare. There we go.
Oh, well, if you're
Pharmaceuticals.
looking,
Yeah.
you can tell I've been taking it. No, I'm just kidding. But it very next gen industry focused thing there with Eli Lilly, Intel, AI chip manufacturing plant in Columbus, all that good stuff. So if you're interested in learning about some of the markets that we are in, that is the best way to do it.
Awesome. Well, thanks very much, and keep up the good work, Ray.
Cheers. Thank you, Dave. I appreciate you having me on, and look forward to the show in the future here.
Sounds good. All right, everybody, take care. We'll see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.